Welcome back to the Neuro Finance Masterclass. Today, on day 114, we run the ultimate corporate stress test. I'm Abram, and joining me to kick off this highly professional explainer and a critical new stage of Phase 2 training is my co-host. We're moving straight from theory right into some heavy, practical application today.
It's absolutely great to be here, Abram, and you hit the nail on the head. Today is all about application. We're zeroing in on a topic that literally separates the true pros from the casual observers out there, predicting debt crises before they even happen.
So let's take a quick look at the syllabus for today's stress test. We're going to start with the oxygen gauge, break down the mathematical formula, learn how to spot the zombies, armor up with the macro tightening shield, and then wrap it all up by deploying the solvency audit.
All right, diving right into Section 1, the oxygen gauge. This is all about measuring pure survival.
Now, if you remember yesterday's explainer on day 113, we audited the skeleton of corporate funding. We dug into the debt-to-equity ratio to figure out exactly how a company's capital is structured. But, here is the brutal truth of finance. Knowing the size of the skeleton, that's really only half the battle, because a massive skeleton without the lungs to support it is just going to collapse. So the question is, does your company actually have the oxygen to survive its debt? We have to frame bad debt for what it truly is, a disease. If a company can't breathe under the sheer weight of its financial obligations, it's going to slowly suffocate. Just seeing that debt exists on a balance sheet doesn't tell us if the patient is actually going to survive the night. We need to know definitively if they can service that debt.
Exactly. And this brilliantly illustrates the massive divide in how different investors actually approach the market. You see, amateurs, they just blindly look at total sales. They spot this massive top-line revenue number and automatically assume, hey, this company is perfectly safe. But remember, we are training to be architects here, and architects do not guess. We point our surgical tools directly at the core mechanics of the business to measure exactly how many times over a company can pay its annual interest using its raw, unmanipulated operational profits.
Which brings us perfectly to Section 2, the mathematical formula, the ultimate survival fraction.
Okay, it's time to scale your quantitative neurofitness with our weapon of choice for this stress test, the interest coverage ratio. You calculate this by taking the company's operating profit, that's your EBITDA, which we actually mastered back on day 106, and you simply divide it by its total interest expenses for that exact same period. We use EBITDA, earnings before interest and taxes, because it gives us the absolute cleanest look at the raw operational juice the business generates, way before any financial engineering or tax burdens get applied. This baseline metric, it's exactly what will protect your portfolio in a downturn.
Right. And to really ground this math, let's use a relatable real-world analogy. Think of it exactly like checking your own personal finances. Imagine you're checking to see if your monthly job salary can comfortably cover the interest on, say, your personal credit cards and bank loans. If your small business makes $100,000 in clean operational profit from selling goods, but your bank loans demand $50,000 in interest payments this year, your ratio is exactly 2.0. You're covering your interest twice over. You actually have a solid margin of safety.
Moving into Section 3, spotting the zombies. Establishing those sovereign thresholds. Now we enter the categorization phase of the battlefield. This is where we let the data tell us exactly what kind of entity we are dealing with. And listen, there is zero room for emotion here. A ratio below 1.5, that puts you in the zombie zone. This is extreme danger. It means the company is spending almost all of its operational juice just to keep its lenders happy. Moving up, a ratio between 3.0 and 5.0 indicates a stable buffer. This is a very healthy operational standard. They can comfortably service their debt and still have enough left over to upgrade infrastructure. But if you see a ratio above 8.0, you are looking at a fundamentally outstanding defensive structure, an absolute bulletproof fortress.
And then, we absolutely must highlight this terrifying threshold, 1.0. A ratio below 1.0 means the business literally has to go out and borrow new money just to pay the interest on its old debt. The company isn't even making enough operational profit to cover the basic cost of its existing capital. It has zero margin of safety. This right here is the true textbook definition of a zombie company. So, the crucial takeaway here is understanding the stark contrast when economic reality actually hits. A zombie company in that extreme danger zone, it slips into default the moment a microeconomic shock happens, maybe just a single supplier defaults, or one key contract gets delayed. Turns out, zombies don't just exist in horror movies, they exist in weak portfolios, slowly eating away at your capital. But a bulletproof fortress? It easily survives even if interest rates skyrocket or revenues unexpectedly drop by 50%. It stands strong while its overleveraged competitors just bleed out.
Which leads us to Section 4, the macro tightening shield, your dynamic defense.
Think back to day 97, when we discussed the mechanics of central banks contracting global liquidity and raising interest rates. The interest coverage ratio isn't just a static snapshot. It acts as a highly dynamic defense mechanism against this exact kind of macro tightening. Let's walk through a crisis unfolding in slow motion for a company that starts with a fragile 1.6 ratio. In quarter one, central banks hike rates, and their floating rate debts adjust upward. By quarter two, the ratio's denominator, the interest expense, mechanically expands. In quarter three, that pressure compresses the ratio below 1.0. And by quarter four, the company hits a terminal liquidity squeeze. You see, they don't file for bankruptcy on day one. They just slowly, painfully suffocate.
And that powerfully dictates our ultimate goal as architects. Our job is to screen out these fragile debt traps from the portfolio completely before the macro shock even arrives. You absolutely do not wait for the credit crunch to hit to figure out if your companies can survive it. You audit their oxygen levels today.
Finally, Section 5, the Solvency Audit. Time to deploy your knowledge. All right, we are now in the deployment phase of today's masterclass. It's time for a direct, empowering call to action, so we can take all of this completely out of the theoretical realm. This is your cognitive task, your surgical homework for today, step by step. Step 1, choose a primary stock from your portfolio watch list. Step 2, open up its income statement. Step 3, find the operating profit and locate the interest expenses line. And then just run the division yourself, calculate its interest coverage ratio. And finally, step 4, compare that result against its direct sector peers, applying the contextual skills we learned back on day 103. So, as you run those numbers and look at the truth staring back at you, I want you to ask yourself this. Are you anchored inside a self-sustaining fortress, or are you secretly financing an over-leveraged zombie? It's time to stop trading on blind faith. Audit the interest coverage, calibrate your survival buffer, and rule the cycle. We'll see you all tomorrow for day 115.